Hi there, good afternoon everybody. As promised, today I'm going to talk about foreign exchange rate. So basically I'm following Mike Penn's textbook chapter 7. Okay, so dealing with foreign exchange. If you guys travel overseas, you know we cannot use US dollars overseas. You say, oh well, I can use credit card, but you know that, right? So when you use credit card, suppose you go to France, right now there's euro and the banks already do transactions for you behind your transaction. So basically they charge you for some handling fees, but again, technically in Europe, they're using euro, we're using US dollars here. I brought you some money here. Of course, this is our money, mighty US dollars. I don't have a $100 bill with me, all right? Normally that's the thing people in Hong Kong really wanted, okay? I have Hong Kong dollars here. Okay, we got 100 Hong Kong dollar and 20. So basically, I'm gonna use this to explain later on why is Hong Kong dollar pegged to US dollar. And of course, I have Chinese yuan, Y-U-A-N, Chinese yuan, renminbi, okay? Also going to talk a lot about it because President Trump talked a lot about it. He was calling the Chinese government as a currency manipulator when he ran for election a few years ago anyway. You just read the book Superfusion. We talked so much about China and US, and you're already US-China expert anyway. So we're going to talk about this later on anyway. So foreign exchange, it just, dealing with this issue just very common for global business because again, we do trading, you want to invest in other countries come here. So basically, anything involved with foreign markets, we need to deal with foreign money, okay? I want to go over, view a little bit on the financial markets. A lot of times we talk about trading, we only emphasize the merchandise, what we buy from China and other places. But actually, the financial market is much, much bigger than the merchandise market. We talk about trillions of dollars anyway. US have a very open stock market, a bond market. The foreigners could buy our bonds, and actually the Chinese owns about 10% of US national debt, and that's the bond, our treasury bills, yeah. But also a lot of derivative exchange is going on. A lot of small investors do the over-the-counter spot market, you can start with a few $100s and just try to take advantage of the exchange rate differences, okay? And stock market, it's a lot of money coming to US, a lot of money also going to overseas, like Hong Kong, only with 8 million people, but Hong Kong is the top 10 financial market in the world because Hong Kong has a very open policy, no restrictions for financial capital, okay? So anyway, exchange rate play a huge role there, and also money markets anyway, reinsurance markets. So anyway, so I just want you to kind of really understand when we talk about global trade, or international business, more than just merchandise trade. It's a lot of financial things going on, okay? Quite a few videos you could watch anyway. Again, I have no time to share the video, but I do want to kind of mention like 2 videos again. Even today, US and China had a trade war for like 18 months, and finally they had a phase 1 agreement. So anyway, so President Trump, a lot of times calling Chinese government is saying currency manipulator. He was saying, the reason, we have such a huge trade deficit with China because the Chinese basically devalue the currency and they dump the goods to US anyway. And that's only one side of the story. Based on my experience dealing with the foreign exchange for the last 20 years, I can give you a different story. Because in 2001, 1 US dollar equals 10 renminbi, and today, 1 US dollar equals 7 renminbi. That means actually for the last 20 years, Chinese currency have appreciated about 30%. So it's not really going down or getting weaker as President Trump stated anyway. But a lot of reasons why exchange rate changes. Today, the main purpose I want to explain the factors which affect the exchange rate between two currencies. Okay. But another thing we need to remember, okay, I think we should be very proud of as American. I said in many classes, and U.S. is still the largest economy. We only have 5% worldwide population, but we produce 20% of worldwide, goods, GDP. So that's something really we should be proud of. So also even today, U.S. dollar is still the main currency. It's the global currency. Other people maybe feel jealous about it, but again, that's just the rule, just the fact, because everybody wants U.S. dollars, the almighty U.S. dollars. And it's kind of ironic when there is a crisis, like right now, after the COVID, 19, and also after the financial crisis. A U.S. currency actually become a refugee currency. It means people actually dump other currency and come to have, U.S. dollars as security. They have, they have a lot of trust with the U.S. dollar, even though you said, okay, we have so much debt. Nevertheless, people still trust U.S. dollars anyway. So this is just some data I got from the internet, basically just from last year. For the global business transactions, U.S. dollars still 90%. Okay, and they have the euro dollar. Look at the Chinese yuan is only about 4% anyway. So you can see U.S. dollar is still the global currency. Okay. Again, when people do business with the U.S. or the U.S. dollars, they have to buy and sell. They have to trade with, in the financial markets to either buy U.S. dollars to pay, the U.S. debt, but also they have to change to other currencies anyway. So we have Canadian dollars here, Japanese yen, Mexican peso, and all those here anyway. You can find those rates change daily. Okay. As I mentioned earlier, the exchange rate between U.S. dollars and Chinese yen, actually, I have the data here. As I mentioned, when I started business in 2001, $1 US equals 10 renminbi. And that cost me a lot of renminbi to get $1 US, because I need to use US dollars to buy DVDs from Los Angeles anyway. But right now, actually, again, it's about 7 renminbi equals $1 US. So you can see actually the Chinese yen or renminbi, it's getting stronger. Okay, and you can say, yeah, maybe US dollars is getting weaker. But also bear that in mind. A weaker US dollar is good for our exports, because when our goods sell overseas, people say, oh, that's cheap, and we're going to buy more American products. And also the Chinese parents say, okay, right now US dollar is weaker, and I have renminbi, I can change to US dollars and cost me less renminbi. I can send my children to US to study. US has about 1 million international students. 1/3 of them is from mainland China. 300,000 something. So that's why when renminbi is stronger, it's good for them. Okay, when it's weaker, it's hard for them to send the kids to overseas, because again, it costs them too much money to change to US dollars anyway. So it does have a huge personal impact. Okay, even for me, because I have to support my parents. Give them money every month. Now give my dad passed away 2 years ago, but my mom, each month I give about $200 to $300 US. So when US dollar is stronger, so it costs me less US dollars to give for the renminbi a month, okay? But when US dollars is weaker, it costs me more US dollars to change to certain renminbi, because I have certain, say, 2,000 Chinese yen renminbi each month. That's about, say, $250 US, okay, at the moment, okay? But then if US dollar getting weaker, and that costs me even more, so anyway, so that's why there's a personal impact here. So anyway, there's a lot of theory to explain why US renminbi exchange rate fluctuates, okay? But again, we talk about the mighty dollar. US dollars share of the world total, say it's very high, about this one's the foreign exchange transactions, because people want our money, and the international service reserve money, and also some banks wants to use US dollars as cross-border bank deposits, but also right? US, we produce about 20% worldwide GDP, but the US dollar is used like close to 90% worldwide. Okay. Again, some people dislike dollar hegemony. Means like, okay, US is number one. This other one shows the foreign exchange reserves 62.25% US dollars. Okay, and the Chinese yuan, the purple one, is about 5%, and the euro is here 20.26%, and then you got the other ones right there, some Canadian dollars, so others, you see that, right? So anyway, you can see. But today I really want to focus on Mike Penn's arguments, based on these 5 areas, the factors which determine the exchange rate, okay? Always bear in mind, US dollar or any currency is just also a commodity. The law of supply and demand, right? So basically, when there's a lot of supply and there's not enough demand, that means what? US dollar could be weaker. But then if there's a lot of demand, not enough supply, then US dollar, will be stronger. So that's just the law of supply and demand, okay? But I want to go to each of them. Mike Penn talks about 5 major factors. And later I want to go to the exchange rate regime, talk about the evolution of IMF and US policy as well. So anyway, so let's go to those 5 major factors which define the foreign exchange rate. The first one, Penn talks about relative pricing. He used the terminology purchasing power parity. I'm going to explain that in details. In the next point. The second one, we talk about interest rates and money supply in each country. Okay. And the third one, talk about productivity and balance of payments, and that goes actually to the trade between countries. And the fourth one is exchange rate policies. Yes, there's a free market, but to some degree, countries could manipulate in some ways. US, we are a free country, but sometimes the Fed can really increase the money supply or decrease the money supply. So anyway, and then the very last one is called investor psychology. It means everybody want to jump to the bandwagon or get out of it. Just like a herd behavior. Happen to the stock market, but also happen to the foreign exchange market. Okay, so I'm going to go with this. Yeah. So the first theory is very interesting. So basically, this theory comes from the law of one price. So what does that mean? Suppose there's no border, right? Worldwide, it's just, say one flat world. So the same thing should cost the same in Hong Kong, China, and US. Suppose, a phone, okay, should be $300 everywhere. And then you say, okay, why is not the same, why is the US cost $350 and China is $200, Hong Kong $300 anyway. But of course we know, right? Because the tariffs, the duties, so anyway. So again, because of not one price, the law of one price does not really hold in this real business world because of those barriers, artificial barriers. Go back to Gamma was theory, like cage. Remember, the distances between culture, countries, cultural distances, administrative distances, geographical distances, right? And then E is economic distances. So because of the cage factors, we could not have the law of one price anyway. But again, the long run exchange rate should move toward the levels could equalize the price of identical baskets of goods in any 2 countries. Okay. I want to introduce you a concept really called Big Mac Index. Okay. So basically, again, you can watch the video by yourself. So a Big Mac, right? So let's say, I think a Big Mac meal right now in the US costs $5.99. I think a Big Mac itself said $4. Yeah, without the fries, without the drink, anyway. But then the economists come up with this like, okay, so technically Big Mac should have the same price worldwide, right? So anyway, so you see the data here, okay? So basically, US Big Mac dollar is here, okay? So they put a price here, I mean, yeah, so 4.8 US dollars, okay, yeah. I think that's a little bit old data, probably included the French fries and the Coke. Okay, let's just stick to here, 4.8. So we use US Big Mac as standard, right? It's from US, it's US dollar. But then the economists were saying like, okay, some countries for the same Big Mac are more expensive than US, okay? We have Australia here, we have EU, and then also we have Canada, and then we have Switzerland, and then we have Norway, you know? So then the saying is like, okay, in these countries, seems like the Big Mac is overpriced, right? That means the currency probably is also stronger, okay? But then look at the other way around, you know, like some places the Big Mac is much cheaper than US, okay? You go to Turkey, it's cheaper. You go to China, it's like much cheaper, okay? You talk about like close to 40, this is 25% cheaper, and this is like 40%, close to 50% cheaper. Russia is right here, okay. I mean, you got the green wine, the 2014 prices here, okay. Indonesia is also cheaper, South Africa is cheaper, India is even much cheaper, Ukraine is also much cheaper. But then, right, you see, there's a problem to economists, okay. So they already say a Big Mac is like 40% cheaper. In China, they only cost them 2% and $3. Then to economists, right, you know, under purchasing power parity should be the same price, okay? So that means what? That means, you know, they said, hey, probably everything in China is underpriced. So basically, they are manipulating their currency in order for them to do more exports. So actually, you get some extreme economists actually use this as one benchmark. They said, yeah, Chinese renminbi is at least 40% undervalued. Right now, it's 7 Chinese renminbi to 1 US dollar. In the real one, should be only 4 renminbi to 1 US dollar. See, the Chinese government is manipulating, so that's why they use that. But also we know, right, in the whole society, it's not just one Big Mac, okay? You know, they have other things too. Some stuff in China is more expensive than the US. You go to Shanghai and Beijing, and their housing prices per square feet is much more expensive than here, right? You see the point? So it's very hard to just use a Big Mac to generalize the Chinese currency is, say, 45 or to 50% cheaper or undervalued than US, okay? But some economists do use that as an argument, okay? All right? Okay, so the Big Mac index is very common, but again, explains something, purchasing power parity, right? Okay, purchasing power parity, yeah. It's very interesting. In about 2015, IMF, International Monetary Fund, suddenly declared that Chinese economy is the largest economy based on purchasing power parity over US, okay? Because they say, hey, you know, the Chinese prices are undervalued, so we should hike that up, yeah. But if you use the exchange rate, you know, we call the nominal rate, US GDP is still number one, about 21 trillion, and Chinese is about 14 trillion US dollars anyway. So Big Mac is really commonly used. I would say makes some sense, but it's just sometimes too much generalization. But it does, in a sense, affect the exchange rate again. So it's important to understand this concept. In the long run, a Big Mac should be the same price worldwide. But in the short run, probably does perform some kind of affect either way. Okay, so it's very important concept here. Purchasing power parity. Okay, let's go to the second one. Okay, and the second one is we talk about interest rates and the money supply. Okay, I think you guys understand right now, because of the COVID-19, Congress just passed a stimulus bill is about 2.2 trillion US dollars. And actually, the Fed lowest lending rate close to zero. Okay, so basically right now the interest rate is so low, and basically government wants to give the incentives for business to borrow more money, cost them less money, the cost of money. And also President Trump is talking to, is proposing to Democrats like, okay, now it's time for us to fix the infrastructure. We can borrow money, basically like a zero interest rate. Of course, there's still cost for that, the handling fees, transaction costs anyway. So basically, the interest rate and money supply also, in a sense, affect the exchange rate. So basically, if a country's interest rate is high relative to other countries, then the country will attract more foreign funds. But right now, US interest rate is so low, probably just opposite, right? People probably will buy less US bonds. But then I also said earlier, right? During this current crisis, people still feel comfortable to put their money into US, T-bills. We'll see how it goes, okay? Also, a high interest rate will also increase the demand for home currency, the enhanced exchange rate, okay? I would say right now in US at this moment, even under Trump administration, really, America first, and Trump wants to push more US exports to other countries, and the interest rate is low. I would say US government is trying to have a weaker dollar, a lower interest rate policy to stimulate the economy, and so that means our exchange rate, still consider other countries will be lower, and a weaker US dollar is good for our exports. Yeah, but also remember that it's not good for our imports. Okay. The third one, talk about productivity and the balance of trade. So basically, I think, you kind of know the picture right now. Yes, US, we are very innovative. Our workers, the average American worker, their GDP productivity each year is more than 100,000 US dollars. And still one of the highest in the world. The highest, as I read a few years ago, or just not too long ago. And the Chinese workers only produce about, say, 25,000 US dollars to 30 per year. So basically, US have a huge advantage in productivity. Of course, good productivity comes from innovation, from good education and creativity, anyway. So basically, when we go to the balance of payments, let's talk about a country's, balance sheet, from the international transaction statement, including our exports. But again, when we keep buying from overseas, and we do have a trade deficit, not just with China, we have a trade deficit with every country. But remember, when those countries like China, Japan, or Canada mix US dollars, and they cannot just put US dollars in their own domestic, change to their domestic money, change to Chinese yuan or Canadian dollar. That means they're gonna have a huge problem with inflation. So to balance that, they have to buy the US financial assets. One of the most common ones like treasury bills, the T-bills. And Chinese own about like 1.2 trillion US dollars. And also Japanese is the same thing anyway. So basically, technically, they cannot put the US dollar they made there, but they have to put it back into US treasury here. So this also, in a sense, would affect our exchange rate, because in a sense, you see, the foreigners are financing us for long-term expanding. If you go to buy a house, even right now for 30-year mortgage, it's less than 4%. That's just so cheap. You think about it. The inflation rate every year is about 2%. So basically, we can say the Chinese, Japanese, Canadians, in a sense, kind of help us to invest for the future. Okay, so that's why probably have a weaker US dollar and the lower interest rate here too, right? So it's not really necessarily bad things for us. But of course, the other argument is like, okay, yeah, we can just keep borrowing money from the foreigners. A debtor is always a slave to the, a person lends you the money, But again, at this moment, especially in this financial crisis, business needs cheaper interest rate loans. Individuals need cheaper interest loans, so they will help them to basically we can spend the money, so stimulate the economy. Okay, so again, the interest rate do have an impact on the exchange rate. Okay, the next one is really related to government micro policy. Okay, U.S. we're the largest economy, even though we are a free economy. The Fed does have a lot of power. The Fed, supposed to be independent from the president. President Trump has been really tweeting and push the power of the Fed chairman to lower the interest rate. Nobody was actually expecting this COVID-19 before. So anyway, when we talk about exchange rate, some countries have floating ones, some countries have dirty float anyway. But overall, US, we have a flexible exchange rate, so it means government policy, let the supply and demand conditions determine exchange rate. Again, we are a free economy. US, we emphasize the free market economy, and we're mostly here. Okay. But some have like a clean or free pure market solution to determine exchange rate, and that's pretty rare. Okay, as I even mentioned, right? President Trump was pushing the Fed chairman to basically increase the money supply and drop the interest rate anyway. So basically, it makes US dollar weaker, so we can do more export to other countries. Yeah, okay. But another one like dirty float or managed float, of course, China is on the list. As I said, President Trump was calling Chinese government, a currency manipulator. He used other even more worse terms. I don't want to repeat that anyway. But again, governments do have some power to manipulate in some ways. But also remember, there's a huge cost there. If the Chinese try to keep the renminbi lower, they have to keep buying, US dollars, So anyway, so it's just a lot of things going on anyway. Costing a lot of money to maintain certain exchange rate too. Okay, but no such thing as free lunch. Okay, all right. The other one's fixed exchange rate policy. Okay, so government policy to set exchange rates of currency relative to other countries. It's kind of interesting. The Chinese government claimed 2 or 3 years ago, they have this basket of goods, means currencies. They have US dollar, euro, Japanese yen in these baskets. And they actually follow the free market, okay? Some countries have the target exchange rate, okay? Like we need to reach a certain rate, and then again, you need to do a lot of kind of manipulation there too, all right? But the very last one is peg, and I brought my Hong Kong dollar here. Okay, this is, yes, this is Hong Kong dollar. Yes, my Hong Kong dollar. This is Hong Kong dollar. There's 4 banks in Hong Kong actually issue money. Okay, but of course I have to report to Hong Kong, Hong Kong Monetary Authority anyway. So Hong Kong dollar is pegged to US dollar. I think since 1970s, and for the last 20, 30 years, 1 US dollar equals about 7.7 to 7.8 is pegged. And it's kind of ironic, but 1 year ago I went to Hong Kong, I've never seen Hong Kong dollar become so weak. I actually went to 7.83 or 84. That means the Hong Kong Monetary Authority allow Hong Kong dollar even pegged in a weaker way, because say from 7.7 to 7.89, that's still like some percentage there anyway. So technically we could say Hong Kong dollar is pegged to US dollar. Okay. The last one, the last factor affect exchange rate is really psychology. I guess we are human beings, and we have, in a sense, sometimes very irrational behavior. We follow each other. Okay, and the scholars call it bandwagon effect. So basically, everybody, when things are good, jump on the bandwagon. The effect of the investors moving in the same direction at the same time, like a herd. Last month is March Madness. I'm talking about the stock market, right? The stock market or mutual funds or those money, they're like lost about 25%. It's one of the worst ever since some say 1938. Anyway, you can see is a lot of herd behavior right there. So basically that also could affect exchange rate. But sometimes also capital flight happens, a phenomena which a large number of individuals and companies exchange domestic currency with foreign currency. And this is actually said exactly, it's kind of funny, when there's a crisis, especially like in financial crisis in 2008, and people actually dumped Japanese yen and the euros and the Chinese money and then cash to US dollars. And the capital flight comes to US. So in a sense, probably push the US exchange rate or US currency a little bit even stronger. Okay. So basically, these 5 factors affect the exchange